Hello guys, welcome to the video of CMA US Part 1 Section A series. In today's video, we are going to talk about investment in debt securities. Now, why we are studying this chapter? First of all, understand the logic behind it. So sometimes businesses, they have excess cash with themselves. So what they do, they invest those cash in different kinds of securities. It can be equity securities or it can be debt securities. Today we are going to study about the debt securities. Now, what problem we are solving? The problem we are solving is that how to value that debt securities, whether it should be valued at its cost or its market value. That is our first problem that we are going to solve. Then what is another question? Another question is that when there is an increase or decrease in the market value, we should record it in the income statement or it should be recorded in statement of changes of shareholders equity. Then the next question we are gonna solve is that how do you account for credit losses? What are credit losses? We have a debt security. We have given debt to someone and in exchange of that we have got some security, kind of like security means what? A piece of paper, just to be precise, like bonds, debentures. Okay, now when I have given money to someone, there could be a chance that they would default on that payment. They would not pay us back. So in that case, what will happen? In that case, this could happen that we have to record a credit loss. So how to account for those credit losses, that we are going to study. Then coming to the question of why this concept exists. So why this concept exists? Because why companies invest, first of all, because when companies they have excess money, they have to do what? They want to earn returns on idle cash. Whatever excess cash they have, on that they want to earn some money. Then in order to manage the liquidity, that means excess money is there which is not needed, which is making the company more liquid. So that is why they invested somewhere in order to show that they have more of current assets or maybe assets. Then in order to gain the strategic control, that means they can use the money wisely. That's how they are showcasing this with the help of investing the money. Then why accounting standards were created for this purpose? Because now suppose if I have investment in debt securities for continuous 4-5 years, I want to compare my books of accounts from previous periods. So what I can do, if I'm following a particular standard, if I'm following a particular accounting standard, so what will happen? There will be consistency in the reporting. There will be a consistency in my reporting, and also my books of accounts will reflect the true economic value. My books of accounts will reflect the true economic value. That means what is the actual value of that particular debt securities, that will be reflected. Then separate temporary fluctuations versus real performance. Whatever changes are there in that particular instrument, that will be reflected, and also what is the real performance. That means what actually is happening, that is going to be separated from what is the some temporary kind of fluctuations. Then first of all, they are what? Long term and stable. That means these debt securities, they are held to collect the contractual cash flows. Why? Because the debt securities, it will be clearly mentioned that what is the duration of this particular kind of debt security, how much money we are going to get, that is mentioned on that particular document, which is termed as a contractual kind of agreement. Then they are actively traded. That means we are selling them and buying them on the stock exchanges or maybe in the relevant markets. Then there could be credit risk. Credit risk can be there. So credit risk means what? Credit risk means what? That the issuer, that the person from whom we have bought that debt securities, they may default on the payment. So that's why this concept comes into the picture. Now coming to the types of investments, we have two types of investments. One is the debt security, where we represent loan. We have given loan to other people. Then other kind of the security is equity security. That means we have purchased the ownership in a particular entity. So in case of debt securities, what we will get? We will get the interest income. In case of equity, what we are going to get? We are going to get the dividends. Then what is the marketability of these securities? That is whether they are marketable or whether they are non-marketable. So if they are marketable, that means they are easily traded. If they are non-marketable, that means there is no active market for the same. Coming to the accounting techniques, that means this column denotes what kind of security or what kind of investment is that, and how should we account for that. That is mentioned in this particular table. So see, held to maturity, available for sale, and trading, we are going to study in the subsequent slides. These three, when we talk about these three, these three. When I talk about these three, private equity, whereas in private equity what happens now, if we have equity with us, we are gonna record it at what? We are gonna record it at its cost less impairment value, cost less impairment value. Then if we have ownership in any of the business, 20 to 50% of ownership, that means 20 to 50% of the assets we have bought, then we will record using the equity method. If we have more than 50% ownership, then we will follow what? We will follow the consolidation. Then we follow what? Then we follow the consolidation. Now coming to the classification of debt securities. So we have three types of debt securities: HTM, AFS and trading securities, or this trading security is also termed as HFT, held for trading purpose. What is each kind of security? We'll see in the subsequent slides. Now one exam thinking tip: if ever you get confused that this is which kind of security, then what we need to do, first of all we need to identify that why the investment is held, why the investment is held, why do we have this investment. Then on the basis of that we determine the accounting treatment. On the basis of that we determine the accounting treatment. Now coming to the held to maturity. In case of held to maturity, as the name says, held to maturity, that means unless and until this becomes mature, that means it comes to an end, the value of the inventory, the value of the security we are gonna get back. Like I have given to you, I have issued a debt security, I have issued a bond. So what is happening? You have taken bond from me, I am the issuer and you are the purchaser of the bond, and you are planning to hold it until maturity, and I have written on that bond that that bond is gonna be there for 10 years. So that is what I'm gonna hold it till 10 years, then is termed as that it is a held to maturity security. Okay, so held to maturity is clear to you guys, that unless and until we receive the money back from the issuer, I'm gonna hold it till that time. But there is a condition. What are the conditions? There are few conditions. What are the conditions? Very important, these conditions, that you should have the intent as well as the ability. Intent, that means you are able to, that means you have the intention, you have this will to hold that particular security until maturity, and you have enough cash available. Without any cash constraints, you can keep that security until it matures. So both must be present, not just one. That means intent and ability both should be present. And how it is measured? It is measured at the amortized cost. This is measured at the amortized cost, so that market fluctuations are ignored entirely. Market fluctuations, they are ignored entirely. That means amortized cost means what? The cost at which you have purchased that security, at that cost you are gonna record it, at that cost you are gonna record it, so that if there is any increase or decrease in the value of that particular security, that you're gonna do what? That you're gonna ignore, that you are not gonna account for. Now coming to the key features, one key feature is given: adjust for premium and adjust for amortization. I'll explain this to you guys with the help of a very small example. I'll help you this guys with the, I'll explain you this with the help of example. Now suppose the cost of that buying that security is 100, but my purchase price is say 120. My purchase price is 120. So how much extra did I pay? I paid 120 minus 100 as extra. So this 20 bucks is my premium amount. Why? I paid more than what is the value of that. So this premium needs to be amortized. This premium needs to be amortized. So we need to do what? We need to just record it at 120. We need to record the security at 120, and this 20 we will amortize over the duration. We will amortize over the duration. So what it will become? So that it gets amortized in my income statement. Now if the case would have been vice versa, if I would have purchased this for 80 bucks, if I would have purchased this for 80 bucks, so what will happen in that case? Whatever 20 is there, that 20 will be what? That 20 is the discount. That 20 is the discount which needs to be amortized. That discount needs to be amortized. So that is how we are adjusting it. So no fair value adjustment account is needed. Why? Because we are holding the security, at its amortized cost. We are holding the security at its amortized cost. What is the impact on income statement? Interest income is recognized, adjusted for amortization, and realized gains and losses only. Realized gains and losses and only. Now, one special rule for callable bonds. If the bond is callable, the premium must be amortized to the earliest call date, not the maturity date. What is a callable bond? Callable bond means what? Callable bond, I'll just take one example. So we will have one callable date and we will have one maturity date. Bond is what? When a company borrows money from the public and in exchange of that money they give them a document which is the bond. On the bond, the interest rate, the duration, the price of that bond is mentioned. So after how many years it's gonna mature, that is what the maturity date is. Now suppose this is 31st December year 5, but my callable date is 31st December year 3. In that case what happens? What will happen, that now suppose if I have a callable bonds, that means whenever the issuer of the bond, if I have issued the bond, I want to do what? I want to return back your money whenever I want. So that will be termed as a callable bond, and I will declare a date. That means I am saying that this bond is gonna mature though in year 5. I am gonna pay you back the entire money on year 5, but there could be a chance I can repay your money by year 3. So that in that way, what will it become? It will become a callable date. So this will be my earliest callable date, and I will amortize my premium until this date, until this callable date. That's what this is talking about. Then one important examiner twist is that if the company has intent but no ability to hold till maturity, classification as HTM is not valid. That's what. Why? Because in order to ensure that a particular security is held till maturity, what condition should be satisfied? That the company should have intent but no ability. It has the intent but no ability. Intent hai, I mean they have the will but they don't have maybe sufficient cash or sufficient resources to hold it till maturity. So in that case, I'm not gonna term it as held to maturity, because both intent and ability should be there. Coming to the available for sale securities, as the name says, available for sale. Which will be the securities? Those securities which are not classified as HTM or trading security. That means any security which is not falling under the category of held for trading or held to maturity. Then what will it become? It will become available for sale security, and this security is carried at its fair value on the balance sheet using a fair value adjustment account. And any interest income, any interest which we receive will go under the income statement, and it should include the premium and discount amortization. But any unrealized gains and losses will go in my OCI and will not go in my income. Please remember this, guys, this point and this point. This is very important. These 2 points are very, very important. Then what is the memory trick? AFS, away from statement. That means any unrealized gains and losses goes to OCI, away from income statement. That's what this trick is about. Coming to the trading securities, this is held for short-term profit for price changes. And what is the intent? Intent is to buy and sell. Active buying and selling is the intent. And measurement, how do we measure it? We are carrying it at its fair value. And this is the same as available for sale, but the destination of gain and losses is different. Why? Because in case of available for sale, unrealized gain and losses used to go into the OCI, but interest income used to go in income statement. But in case of trading securities, this critical difference is there, that all gains and losses, both realized and unrealized, go directly to the income statement. Both realized gains and losses go to the income statement. Nothing goes to the OCI. Nothing goes to the OCI. So what is the memory trick? Trading touches income immediately. That means every fair value changes hits the income statement right away. Any changes will go directly where? In your income statement. Here we have been given the comparison in tabular form for HTM, AFS and trading, all three. Measurement, that means at which price you should value it on your balance sheet. Held to maturity at amortized cost. AFS and trading both at the fair value. Unrealized gain and losses, we don't have anything as such in case of HTM, but in case of available for sale, it goes to OCI. In case of trading, it goes to income statement. Realized gains and losses, every realized gain and losses goes to income statement in the category of all three securities. Then interest income for all three will go in the income statement. Then fair value adjustment not used. Why? Because this is carried at amortized cost. Fair value adjustment, it is there. Fair value adjustment, this is there. Then credit loss model, CECL model is there. Then in that case we have this CECL model. In this case we have the impairment model. In this case we don't have any such model because everything goes directly where? On my income statement. Then at the bottom of the page, mnemonics are given. HTM, hide the market, that means market values are hidden and we record it only at what? Only amortized cost. Then AFS means what? Away from statements. So it is away from statements, that means unrealized changes go where? It will go away from the statement, that means away from the income statement into the OCI. Then if trading is there, touches income. If trading touches income, every change touches income immediately. Every change touches the income immediately. Then we have the reclassification rule. So what is happening? That every reporting date the company must reassess its classification of debt securities. Circumstances change and the accounting must reflect that reality. So first of all, how do we reclassify? Reassesses at every reporting date. Well, that means whenever we are changing the security from one kind to another, if held to maturity security is being changed into available for sale or held for trading. So how do we do that reclassification? First of all, we need to reassess the classification of each kind of security, whether it is a HTM, whether it is a AFS, whether it is held for sale or not. Everything we should reassess at every reporting date. Then HTM becomes invalid. When we are no longer able to or maybe have the intent to hold the security till maturity. Then what is the consequence of the reclassification? The consequence of reclassification could be that if an HTM is not correctly classified, then there could be a chance that a company may be not allowed to classify a security as held to maturity. So this is a significant examiner twist. That's how examiner can confuse you. So in the examiner twist, what is there? That questions may change the classification mid scenario. Always reread the intent and the ability conditions carefully. This is for what? This is for the held to maturity. This is reclassification is for what? This reclassification is for held to maturity. And what can happen? It can happen that this particular intent or ability can be changed mid of the question. So we should be careful about that. Coming to the credit losses. Now in case of held to maturity, whenever we will have a credit loss, there could be a chance we can have credit loss. So that's why we have the CECL model, current expected credit loss model, which is a forward looking model. That means what can happen in the future, what can be the expected future losses, not just the incurred but the expected future losses. That we are gonna do what? That we are gonna consider. What is the key principle? That even a small probability of credit loss must be considered and recognized immediately. That means if there is a small chance of being there could be a credit loss, in that case that loss should be considered and should be recognized immediately. Where should be recognized? On my income statement. What should be the journal entry? We should debit the credit loss expense and credit where? In allowance for credit loss. There is a contra asset account. Like you guys remember, for accounts receivable we used to have allowance for accounts receivable, principal, allowance for credit losses, allowance for bad debts, whatever you called. Similar way we have for credit losses when we have held to maturity security. What is the exception? For the risk free securities, that means any security which you have bought from the governments, they that there is not going to be any credit loss, because we are pretty sure that government is gonna do what, repay us money. So those securities are risk free securities, and for that we don't have to use the CECL model. So how do we do that? We estimate the losses, then we create the allowance, and then lastly we recognize the expense. The CECL model ensures that HTM investors do not ignore the credit deterioration simply because they intend to hold the bond to maturity. So what does the CECL model ensures? That held to maturity investors do not ignore the decline in the value of the credit worthiness of the bondholder. So that means if there is, what is happening, that if there is any decline in the value of credit worthiness, like there could be a chance that my entire money cannot be recovered, so that will be a trigger point and we will record it as a credit loss expense. We record it as a credit loss expense. Now, credit losses in case of AFS, available for sale securities. Acha, for held for trading, we don't have anything as credit loss because any changes is recorded where, in the income statement. Now, for available for sale securities, what has happened? When do we record impairment? When the fair value is lesser than the amortized cost. When the fair value is lesser than the amortized cost. Fair value is lesser than the amortized cost. So then we should record the credit loss. We should compare the cash flow. Which cash flow? Compare the present value expected cash flow versus the amortized cost of the security. So these two we need to compare. Then whatever loss we are gonna get, we need to split the loss. Like if it is a loss related to credit loss, it should go into the income statement. Whereas if there is any other kind of loss, it should go to the OCI. It should go to the OCI. Then one important limit, credit loss recognized is less than the difference between the fair value and amortized cost. You cannot recognize more credit loss than the total decline in value. That means what should be my credit loss? My credit loss should be equal to the difference between the fair value and amortized cost. My difference should be what? My credit loss should be the equal to or lesser than the difference between the fair value and amortized cost. We cannot have the credit loss more than the actual decline in the value. What is the actual reduction? We can't have more than that. For example, I'll take one example for better understanding, guys. I'll take one example. Now suppose my fair value is given. My fair value is say 100. My amortized cost, AC I'm writing, amortized cost is say 120. So the reduction is how much? How much should be my credit loss? My credit loss should be equal to 20 or less than that. Why? We cannot recognize more credit loss than the total decline in value. We cannot have a credit loss of more than 20. Now, what is the type of loss? The type of loss is, first of all, credit loss is recorded where? On the income statement, and non-credit loss is recorded where? Non-credit loss is recorded on my OCI, on my other comprehensive income. What are some factors to analyze the credit risk? What are the factors to analyze the credit risk? But that means, first of all, in order to understand whether a credit loss is there or not, so we must consider what? Multiple things. First of all, the condition of the financial condition of the issuer from whom we have bought a debt securities. Then if they are not paying, if they have any history of delayed or missed payments, then credit rating changes. That means if there is any change in the credit rating of that particular of this particular issuer, then if the industry in which the issuer operates, that is seeing a downturn, then in that case there's a indication that there could be a credit loss. Then as per the economic forecast, like for example, if we are many people are forecasting as of now that because World War III is about to happen, so because of that there could be a chance that certain kind of industry, maybe say transportation industry, might decline. So in that case, if we have a debenture or maybe a bond from that particular issuer who operates in such industry, then we should factor in the credit loss accordingly. Now we have few examples. Okay guys, let's have a look at the examples now. Let's have a look at the examples. So we have 4 examples. Example 1, 3 and 4 is on this slide. Example 2 is on the next slide. First is the about the held to maturity. Held to maturity bond is purchased for 1 lakh. Discount is 5,000. Annual amortization is 1,000 rupees. So what is happening? That is bond discount is 5,000. The bond is purchased for 1 lakh. So the interest income increases each year due to discount amortization. Whenever we have discount amortization, what does that mean? That we bought the bond cheaper. How much is the discount? 5,000. And what is the bond's price? It is 1 lakh. From 1 lakh 5,000 we subtract 95,000 is the value of the bond. 95,000 becomes the carrying value of the bond. So this carrying value has to be increased to 1,000 over a period of 5 years. Over a period of 5 years. And how much is the discount? 5,000. So 5,000 will be increased over a period of 5 years. So 5,000 divided by 5, how much? 1,000 will be my annual amortization. 1,000 will be my annual amortization. Then next example we have the next example. Bond cost is given over here for the trading. This is for trading security. Then fair value at the year end is 1 lakh 10,000. So we will record an unrealized gain of 10,000 in that scenario. We'll record an unrealized gain. Why? Because for the trading security, any increase in the value, it is not directly recorded. Okay, it is recorded as a gain. Okay, it is recorded as an unrealized gain, or maybe this could be a case of this not realizing this gain. Then what do we have? We are debiting the fair value adjustment by 10,000. We are crediting the unrealized gain of income. Unrealized gain, yeah, so this is unrealized gain of 10,000. So this 10,000 increase in the value is recorded as a fair value adjustment, and it is debited by 10,000, and the unrealized gain goes into the income statement, which becomes 10,000. Okay, so the all the gain which is will be directly related into the income statement. Coming to the example for when we have the credit loss on held to maturity. So what is happening? Amortized cost is given, expected loss is 3,000. So in this case, what will be the journal entry? Debit credit loss expense, credit allowance for credit losses is becomes 3,000. The impact, what is the impact? So the net carrying value of the bond, the net carrying value of the bond will be 1 lakh minus 3,000, 97,000, and it will be hitting my income statement immediately. It will be recorded directly on my income statement, which will be recorded this credit loss expense of 3,000. Then available for sale credit loss. What is the available for sale credit loss? So this is the most complex example, and it is one of the favorite of the examiners. Please be very attentive, be very careful when I am explaining this. So data is given over here to us, amortized cost is given to us, 90,000 is the fair value, and the total decline in the value is 10,000. Fair value is now becoming 90,000 and the total decline is 10,000. But the credit loss, when we assessed the credit loss, it came to 6,000, and the remaining loss is 4,000. So this 6,000 will go in my income statement immediately, but this 4,000, this unrealized loss will go to my OCI, and the credit loss will go directly in my income statement, now. So in case of AFS, unrealized loss will be there when there is no credit loss. So now when we have this, 1 lakh is the bond cost, fair value is becoming 95,000, losses of 5,000. So in this case, what is happening? There is no credit loss. This is the case when we have unrealized loss. So unrealized loss will go in my OCI, and credit will be fair value adjustment of 5,000. What is the key point to remember? That this is a market loss only. This is a decline in the value of the this particular security. This does not denotes a credit loss. This doesn't mean that that this much amount of money I'm not gonna recover. So this is related to the market. This is not related to the issuer of that particular security. Okay, so the entire loss will be recorded in my OCI and nothing to my income statement. Why? Because we will record only the credit loss. What is credit loss? That means there could be a chance that the person who has issued this security is not gonna pay me back. And in the case of this example, when we have this 5,000 of loss, this is the decline in the value, fair value. This is not because of the credit loss. So over here the fair value options is given. So the companies may elect fair value reporting even when it is not required by the standard classification rule, and if this is an irrevocable election made at the time of purchase. That means if we have done what, if we have ensured, if we want to, if we have done this, that we are recording at the fair value, we are recording at the fair value a particular kind of security, then we cannot go back to the some other method of recording. Like for example, for the held to maturity, it should be recorded at amortized cost, but if I am choosing the fair value method, then always I should record the held to maturity security at its fair value, and any changes in the fair value will be recorded where, in my income statement. Now coming to the AFS, available for sale security, if we are recording it at the fair value, any changes go to the OCI. But if we are using the fair value measurement option, in that case any changes will be recorded where, in my income statement. So when do we elect the method of recording that particular asset? The election must be made at the time of purchases, and it cannot be applied retroactively. That means once we have purchased, that time only we have to choose it. Okay, then applied on a security by security basis. You can elect fair value option for one bond but not another. That means now suppose if I have two bonds, one I have bond bought from Reliance, one bond I have bought from Tata. So in that case, if I am choosing fair value method for Reliance bond, that doesn't mean that for the Tata bond also I need to choose the fair value option. I can choose some other option, like I can stick to the amortized cost option also. Okay, then it cannot be switched later. That means if you have chosen one kind of accounting treatment, at what cost this should be measured, then it is irrevocable. That means I cannot change the method. Then still amortize, even with the fair value option you must still amortize the premium discount. Fair value changes go to income. That means if there is any premium or discount, and even if you are using the fair value method, in that case also the premium and discount should be amortized as usually, and any changes to the fair value is recorded where, in the income statement. So just to summarize guys, if there is any changes in the fair value of any security for which you have opted fair value measurement, in that case that change has to be recorded where, that change has to be recorded in my income statement. Now coming to the how this topic can be tested in the examination. So classification based MCQs, that whether a security is HTM, AFS or trading. Then calculation questions, that means you can be asked to compute the amortized cost, fair value adjustment or credit loss amount. Then OCI versus income identification, when a loss should go to OCI, when it should go to income statement. Then there could be a scenario based question. Then top 5 examiner twist, gives intent but not ability for a particular security to keep it till maturity. In that case this will not be an HTM. Then mixing the credit loss and the market loss. Then including the callable bonds. Then changing the classification in between the question. Then hiding the ownership percentage for classification confusion, that these twist examiner can put. And where we can get confused, recording the held to maturity at fair value, jabki held to maturity is recorded at amortized cost. Then sending AFS gains to the income, whereas AFS gains which are unrealized one, they go to where, they go to the OCI. Then ignoring the CECL for the HTM, ignoring the current expected credit loss on for a HTM model, because we use the CECL model for the held to maturity. Then treating all losses as a credit loss. All loss is not the credit loss. Some can be the decline in the value, and that should be split accordingly between the income statement and between the OCI. Then forgetting reassessment requirement, that means classification must be reassessed at every reporting date. That means at every reporting date we should reassess whether a particular security is under the correct classification or not. Then students almost most of the time they get confused where unrealized gains and losses should go in income versus OCI. So always remember that unrealized gains and losses go to the OCI. Some key terms, keywords over here are mentioned. These keywords you should must remember, and you should understand the application of this and what does each stand before you go for the examination. Okay, and lastly the summary is given over here. summary, memory tricks, and exam tip that always identify the intent and the ability. That's how this is entirely covered. This investment in debt securities, it was a very small chapter. What we need to remember, there are three types of securities, how do we value them and everything, and watch out for the examiner twist and the students mistakes that we are gonna make. I hope this is clear to you guys. Any questions, any doubts, please feel free to reach out to us. Thank you so much.